Well, I'm happy to be here, and hopefully you guys will get something out of this. This is a little different audience. I'm used to talking to a bunch of audit researchers, which means I know a little bit of economics and most of them don't. So it's kind of like the one-eyed man in the land of the blind. Now it's the other way around, the shoe's on the other foot. So I'll talk about auditing because I'm going to assume I know more about auditing than most people in the audience. But this has been an area that I have been struggling with, working in, and trying to get some movement in for quite a while. I'm going to give a few opening remarks here in a second, but I've noticed, I've been doing this a long time. For those of you who actually want to count, this is my 41st year at the University of Florida, which I think officially makes me old. But I've been through a lot of different stages in my career. I started out as my Ph.D. is actually in operations research. So I had a certain level of quantitative analytical skills back in the 80s, which probably have mostly disappeared. Then I moved because I got frustrated with normative modeling and the lack of impact on accounting and auditing. I dabbled in experimental research for a while. Then I moved into field studies. And then around 2002, with Sarbanes-Oxley and the PCAOB being established, I got interested in the economics of auditing. So that's what I've been doing mostly for the last 20 some years. I do not claim to be a trained economist, but I really enjoy reading things that apparently accounting people don't read very often. And it's actually given me some advantages on some of my papers. So what I want to talk about today are some observations I made along the way that this group probably can give a lot more insight than I can. So I consider this a chance to raise some questions in an audience that actually can address some of the issues that I kind of wrestle with. So let me start off with a real simple slide, because let's always get everybody on the same page as what we're talking about if we're talking about auditing and what is an audit. Okay, this is actually a question that is not so easy to answer. I only teach graduate level courses at the University of Florida. So everybody I have in my master's courses in auditing, I've already had intro to auditing. And I learned a few years ago, this is a great question to start the class off because it's amazing. It's like deer in the headlights of a car. They're absolutely terrified when I asked a bunch of kids who've been through auditing one what an audit is. They actually have trouble articulating that. So there's a real simple definition. There's probably different versions of this, but Merriam-Webster is my go-to online dictionary, and just defines audit as a complete and careful examination of the financial records of a business or person. And that's fine as far as it goes. And for a layman, that's probably enough because that's all they really need to know. But it really doesn't open many doors for us from a research point of view. And so I basically, over the past 10 years, by the way, I forwarded some papers. 2 of these were written on speeches, so they're not really technically substantive. 2 are actually published. They're all published, but 2 of them were based on speeches. And so over the last 10 years, I've kind of worked up my own definition, which allows me to talk about a lot of different angles related to audit research. So I would define auditing as an economically motivated professional service designed to reduce information risk that relies on the knowledge and skills of experts, used in a systematic process, considers the idiosyncratic needs of a client, where the outcome is unobservable and subject to market forces and regulatory constraints. Okay, so one thing we can say that's a lot longer. But there's a number of key points that come out of this definition that I think will actually set up some of our later conversations. So let me parse this out a little bit, because I think there's 6 key sections to this definition. And as you will see, as I just briefly go through this, 5 of these actually, in my mind, link directly to potential theoretical work in economics. Now, 2 of these we're very familiar with, the other 3 maybe not so much. But it's an economically motivated professional service designed to reduce information risk. And this is why we exist. This is why auditors exist. Notice it doesn't say because there's a regulator that requires an audit. It's based on the idea that an audit has economic value independent of whatever its compliance value is. There is an economic value to the audit that we need to think about as we do work in this area. And of course, this links it directly into probably the most common area of economic literature that we see in accounting, which is agency theory and related incentives. It relies on knowledge and skills. This brings in experimental and cognitive issues, so that's not really relevant for today. That are used in a systematic process. And so I've done a little bit of work on input-output economics because I've had access to some data within firms that allows me to do that. That's an area that's really untouched in many ways. Considers the idiosyncratic needs of a client. Now, I'm going to come back to this point specifically in more detail in a minute, but there's a whole literature out there, and I'm not sure how many of you may have seen it, because I didn't know it exists, but that doesn't mean anything specifically to somebody who actually works in economics, on the economics of services. And I got reading in that area about 5 or 6 years ago. In fact, I think one of my students is online. He could probably attest to this, that I talk about the service economics and auditing a fair amount now. And I had a paper that came out in AOS that's more of an armchair theory paper that talks about why the service economics of auditing may differ from some of our more neoclassical type approaches to economics. The outcome is unobservable. We can debate this maybe a little later if you're interested, but it does create a role for decision theory. And finally, it's subject to market forces and regulatory constraints. Okay, so this is the other area where we see a lot of research and we're fairly familiar with, particularly the regulation part. I mean, I'd actually say right now that 80, maybe even 90% of auditing research is not really research in auditing, it's research in auditing regulation. There's a whole broad area of auditing out there that has nothing to do with regulation, but we don't see a lot of work in that area from an archival point of view. The experimentalist people still work in that area. And of course, market forces. And we don't know a lot about how audit markets work. And I'm going to come back to that point in more detail in a minute. So the point of this is, with these 6 kind of attributes you can think of, 5 of them link directly to different pieces of economic literature as I understand it, which in theory could allow us to open a lot of doors that we have not seen open from a research point of view. Okay, so why does any of this matter? Well, it is my opinion. Not everybody agrees with this, because we see a lot of atheoretical empirical work these days where there's no hypotheses. But in my opinion, economic theory should condition the archival research we do. But first of all, audit researchers either don't know much about theory or they don't pay attention to it. And if they do, it's usually because they're trying to squeeze the theory in to fit the data they have available. And I'm sure we've all seen papers that try to do this. In fact, if I had more time, I would talk about attribute-based empirical research, where we take some attribute that no one's theoretically looked at or empirically looked at. Like a paper I saw recently was, does an audit partner have a pilot license? That's an attribute. What does it mean? I have no idea what it means, but we can make up a story. And so we do that. Does it lead to better audit quality, higher fees, or whatever? That's the nature of the empirical analysis. But why is the big open question in my mind. So we try to squeeze the theory to fit the data, but then we actually have to realize that the existing audit theory is very fragmented, it's imperfect, and it's incomplete. And if you really want to be honest, it's just basically old. I mean, you don't see too many audit research papers, though, that basically don't refer to either Simonik 1980 or D'Angelo 1981 or both. And a well-read auditing empiricist might actually refer to, say, Dye 1993, I think it is, in Journal of Political Economy, where he shows analytically that auditor wealth affects audit quality. But there's not been a lot of advances in theory, auditing theory. I mean, there's been papers, don't get me wrong, there's stuff, but you don't see it feeding into the archival research, which is something I'm interested in. What we do see is people saying, okay, I have this regression model, I'm going to treat that like it's theory, but it's not really a theory. It's a manifestation of a theory that you may not even be stating. For example, why does a partner's pilot license matter? And so the conclusion I've drawn after going through all this is that there's many underutilized alternative economic theories that exist that might be productively applied to auditing. And so this has kind of been my mission in life. In fact, I identify 3 here that I've used in papers recently. Multi-market competition, where you have 2 suppliers who have compete in overlapping markets, and does it reduce competition? And I have a paper coming out in JAR that says it does. Agglomeration markets, we're using that to look at industry specialization. The classic industry specialization literature is based on market shares. But you can, for example, audit the most oil and gas clients in a place like Denver, and the literature would call you a market specialist, or an industry specialist, But when you compare that to an agglomerated view, which basically says Houston with 76% of the revenue in oil and gas in the entire United States, it turns out that the smallest Big Four auditor in Houston auditing oil and gas is significantly bigger than the biggest Big Four auditor in Denver. But the theory and the markets don't recognize that. And then something I just started on work recently is tier-based regulation, which in empirics usually shows up as regression discontinuity designs. How does having different levels of regulation that apply to different types of organizations affect whatever it is, quality or whatever. And so we see a number of papers like that, but again, they never really invoke any economic theory to support that. We jump straight to the data and the empirical analysis. And that's not to say the results, there's anything wrong with the results. It doesn't even say there's anything wrong with interpretation. It just kind of doesn't satisfy my need to have a more fundamental understanding of what's going on. So why do we want to advance theory in auditing? Well, this is what I'm just going to throw up two of my favorite quotes because it kind of captures the way I think about all this and what I'll be doing. So Thomas Kuhn, some of you may have read his seminal work called The Theory of Scientific Revolutions. I know that many PhD students these days do not get introduced to basically the theory of science. But basically, this is a quote, somewhat manipulated so it wasn't the whole page long. Almost always the individuals who achieve fundamental inventions of a new paradigm are particularly likely to see that old rules no longer define a playable game and to conceive another set that can replace them, meaning to see the world differently. Now, he discussed this mainly in the context of physical sciences, but I think it just applies just as much to what we're talking about. This one's short and more to the point. Don't be afraid to take a big step if one has indicated you can't cross a chasm in two small jumps. Meaning, if you really want to make an impact, you've got to be somewhat ambitious. And this is one of the limitations I see on audit research in general these days, is the small incremental contributions, which often aren't really contributions, but nevertheless, lots of people are chasing these. And I think part of this is because we don't have a different way to see things compared to the way we've been seeing them in auditing for the last 30 years or so. Okay, so that kind of is all by way of introduction, and I'm happy to, as soon as I get done with this, to the bottom of the slide, I'm happy to answer any questions that you may have. I can't necessarily see everybody, so you may just have to start talking. And by the way, yes, I just opened my chat box. Yes, pilot license is a proxy for risk taking, but why is it different than any other proxy for risk taking? It's because we've also seen literature, for example, on parking tickets. Partner parking tickets. Is that a proxy for risk taking? Is it a proxy for ethical reasoning? What is it? And so we end up with we have a proxy and we assert it's a proxy, but do we actually have other proxies? I mean, if you look at audit literature, we know that auditors risk adjust most of the decisions they make. So it's not clear to me why the pilot license tells us something we don't know. That doesn't mean we can't learn something, by the way. It just means that it needs to be laid out in a more, we can't make this almost mystical leap from the data to a conclusion without having a thoroughly well-developed logic chain. And in fact, that's one of the biggest problems I see with a lot of things at the accounting review, is that we just don't see the logic chain. Okay, so where I want to go. So like I said, I've been thinking about this a long time. I actually have 11 items on my list. I'm only going to mention 4 specifically because I don't have time to talk about all 11. I may not even have time to talk about all 4. But basically what I say, I call these the things we absolutely know have to be true because of everything we've done in audit research. And to even question them would be like, you're out of your mind. And so that means I'm certifiably out of my mind, and you can judge that later on. But so let me just highlight 4 things we absolutely know to be true from audit research. One, we know, for example, because we've got 300 or so published papers, and basically we know that audit fees are a function of variable costs related to client size, risk, and complexity. Right? That's probably the biggest, most well-established conclusion in our literature. Second, we know that the outcome of the audit is the result of a standardized production process applied to a singular client entity. Okay, we just know that, right? Like I said, this IO literature, the little bit of it exists. It treats the audit process as a production process, just the same way you would make widgets. And so you can look at the inputs, you can look at the outputs, and you can do the kind of things you do with that kind of data. I have a paper in the accounting review that uses DEA to do that, and we find some interesting stuff. By the way, I should clarify. Any of these things I may end up challenging, I'm just as guilty probably at some point in my career as anybody else. So I'm not like saying this is something that I have solved these problems. These are problems that I think can be solved, but need probably somebody a lot more smarter than me to do it. Third, audit quality can be improved by increasing auditor independence and competence. Okay, that refers to the D'Angelo model, which I'll come back to, assuming we have time. And fourth, audit regulation reduces financial reporting risk. Okay, so nobody would argue with these, right? These are all so self-evident and supported by research, empirical research, that we really shouldn't even be thinking about these things at this point in time. And like I said, I have 7 more of these. Like our audit markets are competitive, and audit market concentration is bad. And so I can go through any of these, but I just picked these 4 as maybe being indicative of the issues. So what I'm going to do, subject to, again, feel free to ask any questions. I'm going to go through each of these ones in a little more detail and talk about why maybe they're not, I won't say so much they're not true as that they're not complete, or maybe they're a little dated. And that we actually have evidence in many cases that refutes some of these that we tend to underappreciate or not think about enough. So let me start with the fee model, because this is the classic area in audit research, right? So the assertion that we know to be true are audit fees are a function of variable costs. This is related to the client size, risk, and complexity in an audit engagement, okay? So how else might you think about this? This is really the whole point of what I'm doing with this. And again, I've given this presentation in various forms, often much longer if I'm dealing with doctoral consortium, to try to trigger people thinking about some different ways to think about these things. So how might I restate this? What I would restate it is audit fees are a function of fixed costs in a limited capacity network that reflect time and portfolio dependencies. Okay, now that's actually a pretty significant alternative view. So what do I base it on? Well, if you look at the current audit fee models that we see in the literature, then essentially, and this is kind of relating back to a few years ago when I had to teach cost accounting, current models of audit fees essentially treat the audit as a job order costing problem, meaning you assign the costs to the job that you're doing, which is the audit, right? So in a sense, it's just like making a chair. It's basically have costs that go into that. Labor, a lot of labor, not much in the way of materials, obviously, and probably some overhead, okay? So out of that for perspective, we see that, for example, that labor is considered a variable cost, and every single audit fee model paper treats it that way. The paper I refer there, I cite there, is actually a overview paper, a synthesis paper on audit fees. We looked at like 250 papers. Demand is assumed to be irrelevant. This is actually fairly important because it assumes the Simonic model assumes perfect competition. The market is complete. The market for audits is complete. Okay, so there is a good fit supplier for every client out there. And the original Simonic model assumed that quality is implicit in the firm name. So a KPMG audit is a KPMG audit is a KPMG audit. We know that's not true because most Anderson audits were okay, Enron wasn't. Because that, so that kind of indicates there's exceptions. Later research has argued that the brand name is actually at the office level, or it could be at the industry specialist level, or more recently now we're even looking at partner levels. Partners are essentially can be individually branded, and firms actually act that way. I've heard a presentation about a year ago about before COVID hit, and we could actually have these meetings that partners were being counseled within the firms on how to build their personal brands. So the question that I come to make this kind of like is there another way to look at this, is I actually started with this question a number of years ago. Do audit firms sell to grow or grow to sell? Now it's kind of like a classic MBA kind of question, but if you think about it, if you sell to grow, it means you make a lot of stuff, you're successful selling it, then you need more capacity, so you build more capacity. It's kind of like making the sneakers model. But the alternative model is you first have to have a capacity, and you have to grow the capacity before you can sell anything. And I would argue that accounting firms are much more like that, particularly if you're talking about global auditing. I mean, you cannot service a multinational audit if you don't have offices and auditors on the ground where those offices or those clients are located. And so if you look at it that way, it is possible that an audit firm has more in common with a fixed capacity network, say like a utility or an airline. I think an airline is a good example, than it does with a classic manufacturing operation. Now that gives you a very different way to look at audit fees, obviously. And I would argue that the audit has many traits that look like that. Essentially, every cost within an accounting firm, let's just focus on the auditing side, pretty much every cost is fixed over some relevant range, right? The staff is generally hired at least for a year at a time. And so what you end up with is a large fixed capacity network where the capacity has to be essentially managed to maximize the return on that investment. And so you end up more with a contribution margin approach to pricing, because you just don't want dormant assets or assets that are underutilized. And this is literally the plane that flies with empty seats kind of thing. Except for in an auditing world, it's a day of staff time where the staff is sitting in the office doing nothing, right? That's billable time that can never be recovered. This type of model then leads to incentives for discounting, bundling services, and service swaps, all of which apply to audit firms. So there's a little bit of literature starting to grow up that's starting to look at this, and what does that mean? Now, the real challenge, though, is what does that mean to all the literature we have on the audit fee model now? Well, as Thomas Kuhn would say, he argued about how usually a scientific revolution occurs when the anomalies in the empirical results or the empirical observations can no longer be explained away by the theory on which you're relying. So we have anomalies in the audit fee model that are really quite striking once you start looking for them. And I can only mention a couple here. We know, for example, there's bias in coefficients. So the average audit fee study now takes the audit fee model that everybody else uses, then sticks in a new variable that has some interest to somebody for some reason, and is the marginal effect significant, right? We don't use it for predictive purposes. We use it for test marginal effects. But we know there's bias in these coefficients. For one thing, and again, I'm working on an interesting paper that I think will get done, but it's one of the harder things I've ever worked on, looking at price discrimination in auditing, because the issue is we run regression models, which really basically are mean-based, right? It's looking at average effects. But in the audit world, actually, most of the stuff that's interesting is not average. It's in the tails. So particularly if you're talking about audit quality, right? The average audit is usually just fine. What we're really interested in are the 5 to 10 or whatever percent in the tail where you got bad audits. No one would argue that the average audit, I think, in this world is bad, but certainly there are bad audits, so they fall into the tails, which led me and my co-authors to start to play around with. I'm not going to claim I'm an expert on this at all, but we're getting there on quantile analysis to look at what the effect of some of the things we assume are true about the audit fee model, do they actually behave differently out in the extreme tails? We get this appearance of stickiness, that fees don't change much over time. Now, most of that actually, some of that literature, some of those papers actually are based on economics. Basically, I guess there's a classic study looking at pricing of Coca-Cola for some reason, and how the pricing of Coca-Cola was sticky over time. But audits aren't like bottles of Coca-Cola. You don't buy one today and then another one tomorrow and then another one the day after, right? You buy an audit once, and that once looks like it's every year, but the reality is you don't buy it once every year. You buy it once for maybe 10 years because you're not going to change your auditors. And so there's this appearance of stickiness, which may be in fact be deriving from something else. And then finally, this is like one of my pet peeves. And how do you interpret the fee residuals from an audit fee model? I call this the Goldilocks effect, because basically you run a fee regression model, you figure out what the fees for a client are predicted to be, you then compare them to the actual fees, you calculate a residual, it's either going to be positive or negative. And depending upon the story you're going to tell, you're going to treat a positive residual as good, unless you want to tell a story that says it's bad. And if you're telling a different story, a negative residual, you would tell a story that's bad unless it's actually good, right? And that's the problem, is the signs on these residuals is not necessarily very interpretable. So just taking a positive residual could be that the auditor is doing a lot more work than you would expect. Well, that would be good usually, because that means higher assurance. An alternative could be is that the market is not competitive, and basically the auditor is extracting rents for no benefit to the market. Well, which is it? Well, that's a question that maybe we can deal with, but hasn't really been addressed very much. And the same type of problem occurs with negative residuals. So what you end up with is this fee is too high, this fee is too low, therefore the middle fee is just right, which is kind of like I call the Goldilocks effect. And we just don't understand. And so different people interpret these fee residuals in different ways without really ever reconciling with each other. Which does lead to the question really that's biggest here is a one period, one client, one auditor fee model appropriate? We know fees have longitudinal serial correlation or dependencies. That's been shown. I would also argue they have cross-sectional dependencies, because if you believe that the audit fee model, or that the audit firm really is a bit of a fixed cost model. Now, I mean, think about it. Auditors are not day laborers. We don't hire them the day we need them and then let them go again. They're on contract for at least a year, and some are going to be on contract for a lot longer. And so then if in fact the audit pricing is really about managing the scheduling of audits such that you can maximize your revenue flow, then there's clearly going to be cross-sectional correlations, dependencies that haven't actually been adequately considered. And I say all this, and we haven't even talked about demand or competition in the audit market itself, which is something I'll come back to later. So are there any questions? I mean, I'm just rambling on, and I should open my window to people.
Hey, Robert.
Yeah.
I'd like to comment on a couple of things that you've suggested here in your outline. And the first one is the view as the model is fixed costs. I believe you're absolutely on point. And what we did
this is a real world view, right? This is a person from the real world.
It's absolutely true.
Okay.
And there's a couple of ways of really squeezing it down. The use of reducing capacity was done by concentrating in certain shared global centers of excellence, Bangalore, India, Indianapolis, Argentina, Chile. I mean, any place where we can basically concentrate it and squeeze it down was one of the ways of basically taking some of that fixed cost and really reducing it as much as we can.
Yeah, let me stop there for a second, because there's been numerous initiatives. I mean, the whole thing of, I remember in the 90s, I was actually working at KPMG for a couple of years as a internal research fellow, and they were, if you remember the early 90s, it was bad for the profession. And they let a lot of people go, only to have to hire them back, from each other at a much higher salary. Then they went into the idea we're going to have paraprofessionals because they're cheaper. Then we went into the idea that nobody's going to have an office. Everybody's going to have cubicles. We're going to go into a hoteling model so that we can cut down on our fixed costs, right? So this is not new.
No, you're right. But sequencing, you try to first reduce your fixed costs and concentrate. The second one is try to convert fixed to variable. And that's where you're going to see a lot more play on 30% of the workforce will be gig. But I'll tell you the item that's not studied, and the reason is we don't discuss it, is I feared excess capacity on the risk side. If you're managing 1 million hours or 10 million hours of production capacity, add that or triple it times the client interactions, a lot of bad decisions are made in periods of excess. Bad, work that we go after, we misprice work. They just simply do silly and stupid things when they're not productively busy. And it's that risk item that I worried about the most. It was in the pricing, it was in activities and behaviors, types of work that we picked up. In that one, again, we don't talk about it, but when I looked at litigation that I had coming at me, I could always trace it towards what time of year did we do it? When did we sign the letter of engagement? When was the first suit done? Yeah, that's when we do our bad behavior. So yeah, I think you nailed it. It's a very different model. We try to manage around it. At times not terribly effective with it. But that one I would tease out is it's what do you do when you have excess capacity and nothing gets, as they say, nothing good happens after 2 a.m. Nothing happens good when you have excess capacity. Nothing.
Right. And well, I'd say the risk is at both ends, because when you're absolutely flat against the wall, then that's when corners get cut and other things happen. And
exactly.
then when I could spend a whole hour and a half just talking about partners and the research on partners these days. But you still have this somewhat, it's less decentralized than it used to be, but it's still somewhat decentralized decision making in accounting firms. And an individual audit partner may want to very much have this new client come in the door, and then it's up to the office people to figure out how we're going to get staff for this engagement when there's no slack in the system at whatever point in time it might be. So these are all very real internal issues that aren't getting studied from the academic point very much, because part of it is we don't have data to get, we're not allowed in the firms to address these questions. I have been fortunate to be a couple of times, but these are real questions. And I do think it throws into, the big point I want to make is it throws into question how we evaluate the existing research on audit fees. As you can imagine, audit researchers don't like hearing me say this, because I can usually just say, it's like a microphone drop moment. It's like, I'm dropping the microphone and I'm retiring. You guys go worry about how to do this now. But it's more about trying to stimulate people to think about these issues. So I appreciate it.
Well, your point number 2 that you're coming up is the one where you could drive a bus through. Point number 2 is massive, and that the industry is changing quicker than people understand. But I'll leave my comments for that after you speak.
Well, we could go on. I mean, obviously you're an auditing guy, so we can go on and bore these people to death about auditing. I'll tell you one little side note. So I've only presented at the JAR conference once, and it was a few years ago, and the paper did get into JAR, so I was happy, but I'd never presented, and I'd heard horror stories about the JAR conference, and one of my good friends said to me, he said, well, if you get a question at the, because you get tough questions at JAR conference, let's face it, right? I'm sure most of us involved here in this have experienced one way or another. And so the person gave me the advice, said, if you get a really hard question that you can't answer, talk about auditing, because I'll have no idea what you're talking about. And it kind of worked, actually, I have to be honest. Okay, so we'll stop talking about auditing for the moment and go on to another point. But I'm happy to answer questions that are more economics based. So second point was, and this is starting naturally, I think, getting into more maybe generalized issues that most of us actually do deal with at some point. The outcome of the audit is the result of a standardized production process applied to a singular audit client. Okay, I would replace that, again, thinking about this slightly different, as the outcome of the audit is the result of an idiosyncratic service process that's applied to a complex ecosystem. Now, the ecosystem part, I'm not going to talk about in much detail, but what I'm really referring to is the entire system of producing a financial statement, which starts with what I would call the process owners who execute transactions within the corporate world, up through the internal control people who execute internal control, up to management, up to the governance structure, by way of internal auditing sitting off to the side here too, and then the external auditors coming in. Okay, that's the ecosystem, and all those players have a part to play. But I'm not going to get into that in detail. I'm really focused on this idea of idiosyncratic service. Okay, so is the audit a production process? Well, what do we know? That audit changes across clients. Every client is different. Every client has a different demand. Every client has different tests they perform, and so on. I mean, you can actually base it down to really granular differences, like different transactions, different business plans, different goals, different personnel, different systems, et cetera, et cetera, et cetera. And we also know that the audit changes across auditors. Okay, that KPMG audit doesn't necessarily get done the same way an Ernst & Young audit gets done. We know there's differences across specialists, offices, partners, and we're beginning to see that there's differences across audit teams, not just the partners on the audit teams. Okay, so that's all based on empirical research. So what is the audit? If it got all these things different, can we really call it a production process? I mean, we don't put auditors in one door and have audits come out the other door, and there's some mystical process that goes on. And so a lot of this evidence actually supports the idea that auditing is a service process. And again, there's a large literature of economics of services. I think a lot of that is in marketing that talks about how a service organization or a service product, good maybe is a better word, is different than a manufactured good. And the kind of like the mantra they hang that literature on is on the idea of co-creation of value. The idea that professional services can only be created in a partnership or what they call collaborative environment. This idea that, I can be the best darn doctor on the planet and it doesn't matter if I don't have any patients, right? And the patients come in and they're all different. Same thing for lawyers, same thing for almost any profession you can think of. And the question is, does that apply to auditing? And I would argue it does, because every client comes in the door with a different set of needs. And part of this comes back to another fundamental idea that I won't talk about in detail, but because I assume some of you may know this, and that's whether auditing is an experience good or a credence good. And I've argued in some of my writings that it's a credence good, because again, it emphasizes this need to make the client and the engagement idiosyncratic. So, point is, there's no single way to do an audit effectively, right? We have a set of standards, right? That's true, but the standards are about process. And if you read any of the stuff I sent you, which fine if you didn't, but I use an example of somebody trying to climb a mountain. There's lots of ways to climb a mountain. I'm going to use the staircase with the handrail as far as I can go, and if I run out, I'm probably not going to go any further. But then you got the risk takers who want to climb up the sheer face or whatever, right? And so there's different ways, but the key is to get to the top, right? That's the goal is the same, get to the top. That's different than, say, accounting standards. Accounting standards are meant to get the same goal, to try to get everybody to get the same goal, to have the outcome look the same when you may have different things going on. So the process is different than the outcome, and the standards for auditing are about the process, which does not preclude multiple, viable, effective processes. Second, as I already meant, it requires this collaboration with a complex network of participants, this ecosystem I referred to, because there are many different stakeholders in this system who care about the outcome of the audit. Furthermore, if you're going to do an audit of a client, you got to interact with the client. I mean, if you're doing a big US multinational, you may be almost living at the client. Effectively, you're embedded, particularly when now that we live in a world where we're testing internal control all the time. And the point being is, if you are that up close and personal with a client, I don't care what theory you use. It could be cognitive, it could be sociology, it could be whatever, it could be economics. You're going to be infected. In fact, I didn't mean to say infected, but I said infected because we live in a world of COVID, right? You're going to be affected by the interactions with the client personnel. Now, we're supposed to be independent. We're supposed to be objective. We're supposed to maintain professional skepticism, but we know that interpersonal relationships affects how we deal with each other. And that's going to affect, question.
Robert, Sri here. Hi. I have a couple of observations / questions.
Yeah.
You repeated a couple of times idiosyncratic needs of clients.
I'm sorry?
You mentioned a couple of times that clients have idiosyncratic needs.
Yes.
Now, if you think about that statement, it's not clear who is our client, right?
Okay.
Is it the management or the shareholders?
Yeah. So when I say needs, let me clarify what I mean by needs before you go on. We can come back to your question. Needs. This gets back to this view of auditing as a credence good. The idea that in a credence good market, the seller is an expert who does two things. They diagnose what the client needs and they deliver that. Now, in a doctor, it's easy. The diagnosis is what's wrong with you, and then the delivery is what do I do to fix you? Pills, surgery, whatever. In the audit, when I say diagnosing needs, what I'm really, and your point is well taken, what I'm really referring to is the risks of that client in terms of material misstatements, right? So it's not needs in the sense this stakeholder wants a high assurance audit, and this stakeholder wants a low assurance audit. it's really independent of that. That is a fair question, but it's not what I'm talking about right now. Okay, does that help?
Let me elaborate a little bit more. So, when you compare auditing as a service to doctors and legal professionals, it's a kind of a very unique system we have, right?
Mm-hmm.
In the sense, the outcome of the audit process, I cannot think of any other service industry where the outcome is so almost uniform across various clients. You just get some really big picture viewpoint that this represents a fair picture of the company's affairs without really giving any specifics about the needs of anybody other than this has crossed probably a certain threshold level. And further, you think about it, who all use the audit services, especially prospective investors who are not currently part of any stakeholders.
Mm-hmm.
But I'm going to rely on your opinion in making an assessment about whether I want to invest in the company that you service, correct? So that makes this a kind of in some ways, while the client's needs, whichever way you define clients, are very, very different across companies and so on, we just don't provide or answer their questions, right? With the level of partition that we would like to provide.
Right. And okay, so let me respond to a couple of those points. First, the easy one. I personally consider prospective investors as stakeholders in the same sense that the local community is a stakeholder, because what is going on in this organization can in fact impact them, even though they don't have a direct economic link to the organization necessarily, right? So I do have an expansive view of who the stakeholders are. And it's, I don't want to get into the debate of a shareholder view versus a stakeholder view. Stakeholder view tends to be more non-US, non-UK type views, but I do kind of consider that in as part of the thing. But you actually raise a really important and interesting point, which is, why do we only deliver a one-size-fits-all product? I mean, the outcome is not one-size-fits-all. The output is, right? The output is a report. And until we got the new reporting standards with CAMS, critical audit matters, it was one page, 250 words, and it was the same for basically everybody, right? Then we've had this debate going on for a while. Can we get more out of what the auditor knows? And that is a real debate and so we got CAMS and we get expanded reports. I tend to be a little cynical about regulatory solutions to that kind of thing, because the regulators make a move, but then everybody else gets to make a move, and you end up, when we're seeing this now with the boilerplate, it's a longer boilerplate, but it's still boilerplate. And so it is a good question. That's interesting. I hadn't thought about that particular aspect. The challenge I usually get on this is that the one thing that's truly unique about auditing is that, and it gets back to your question of whose needs are we talking about, which another way to say that is who is really the client, because you get one view is that management's the client. I don't think that's very, very generally accepted anymore, that we think the shareholders or the board are the client. But it gets to then, what are their objectives? And if they really are strategic players in this ecosystem, what are their incentives? Right? Now, one thing that I have argued is, whenever we get an Enron, it's not, you can call it an audit failure, but I don't personally think it's an audit failure. I think it's a system failure. Because the auditor can't be the only person that screws up in most of these situations, right? At minimum, management screwed up. They may have done it intentionally, which is what makes, I think, our markets different. I think we could leverage this in research in a lot of interesting ways potentially. Is that, okay, the person you're supposed to be collaborating with in the service science view is actually potentially working at cross purposes with you, right? And so the paper I have with David Sappington, whom you may know, in the European Accounting Review, looks at that issue. We factor that in. But that is kind of unique, unless you're a big fan. My daughter's in medical school, so I've been actually binge watching House. Remember the TV show House, Dr. House, for those of you who are in. And I use his quote. He said, he had a great quote in, I think, a couple episodes where he says, patients lie. Right. So we assume managers lie, patients lie too. But so the point is, there is a strategic game going on within this collaborative network. And that's why it's so interesting in my mind to try to figure out what really goes on here. But what really comes out of all that is what we call independence traditionally may not, in fact, be a viable concept, because there's no such thing as pure independence. Right. You can't have pure independence when you're interacting with people, is what it boils down to. It is a cognitive limitation, if nothing else.
Robert, before you go on, I do think it's an interesting, when you look at the role of the auditor, we begin the journey as independent, but the moment that ink is dried on the signature, you're an advocate, you're defending the position with the client. So, that's worthy of a conversation. My concern in this particular area is, if you look at the composition of balance sheets today, 80, 85, 90% of balance sheets are pure intangibles, and they're not goodwill. They're relationship bound, whether it's community, political, supply chain, customers. There's a wide open hole out there that's really not touched. And with the emergence of these new SOC reports that are coming out, where I'm relying on somebody else to tell me about my cloud solution provider, and I think there's a new SOC on supply chains that are out there. I think there's going to be even less credibility on some of these audits, because they're going to point towards a reliance on stakeholder, I'll call it validity, or stakeholder relationships, how solid it is. I'm going to rely on somebody else's report or output. And I think we're looking at a day right now when I sit back and look at, I'll call it the failure of Parler, it getting cut off by AWS. If that company went under, we'd be sitting down looking at the auditors saying, how was this reliance, this dependence on AWS so significant that you missed reporting on it? You didn't tell us that we're entirely dependent on one agency to protect my business, and within a couple of days, I'm out of business. And so there's a change occurring in these business models, and I don't think the audit is keeping up with the changes in business models that are occurring right now.
Yeah, well, that's a whole nother day and a half discussion, actually. So I'm just going to leave that point out there, because I don't disagree with any of that. And I think we do have a, what's the word I want? We have a historical precedent we can actually point to as what would happen. Because while people don't talk about it much, even in auditing, we saw it in the global financial crisis. We saw it in the sense that we were completely reliant upon credit rating agencies for evaluating a lot of assets. And I would argue we did not even follow our own auditing standards on how to deal with expert input into the audit process, because we never vetted we just took them for face granted. So that's it's another issue. Okay, so the bottom line is, because of this idiosyncratic nature of every client and the need to interact, it does affect a lot of things that we think about. And maybe here's one of the interesting economic aspects. The pricing of the audit then depends on the cross elasticities of everything else that's going on in the system. And to my knowledge, no one's looked at that. And that would definitely be way beyond my expertise. Okay, other comments? This is good. Okay, then I'll go to the third point. Audit quality can be improved by increasing both auditor independence and competence, okay? This is really the D'Angelo view of the world. And I argue it needs some refinement. It's not wrong. It's not wrong. It's just that audit quality can be improved by efficiently balancing auditor competence and independence. And the logic kind of follows from some of the things I've already said. Right, so what is audit quality? I suppose a lot of you, if not everybody, has seen this definition before. The Linda D'Angelo 1981 definition of audit quality: the market assessed joint probability that a given auditor will both discover a breach in a client's accounting system and report the breach. Okay, that is used all the time. I mean, that is like gospel, except for the first few words. People forget. They forget that this is a perception, right? They forget this is market assessed joint probability. In my mind, that's a perception. And perceptions depend upon the user to some extent. And so there is no generally accepted correct answer to what audit quality should be in any given situation, because it's going to be based on the eye of the beholder. I once wrote a paper for the PCOB a few years ago, which basically I used, if you may have heard the old story about the elephant and the blind men, and different blind men touch different parts of the elephant and come to the conclusion it's a different thing. And by the way, that's a really interesting story, because it's in different cultures that the number of blind men vary from 4 to 8, depending upon which culture the story comes from. But the point is, so one guy touches a leg and thinks it's a tree, another guy touches the tail and thinks it's a snake, and so and that's basically the point of audit quality. It's kind of in the eye of the beholder. But the way this gets used then is it says, okay, but that means there's 2 dimensions to audit quality. There's competence or expertise, and independence or objectivity. Basically, the competence means the auditor can find the error. If there are, assuming there's errors out there to find, the auditor will find it. That's their expertise. And then if they find it, they'll actually do something about it. Usually that means correcting it. But or blowing the whistle if they have to with a negative audit report. Okay, so those are the 2 different components. But implicit in this, and I think this is it's more important than people realize, there is an implicit assumption that these 2 dimensions are completely orthogonal, which means you can improve one without changing the other, and vice versa. And I don't know of many things in the real world where that would be true. It almost always there's a trade-off. You think about attributes of an economic good. Like you want to buy a car. You want a car that goes fast, and you want a car that gets good gas mileage. Well, you can't get both infinitely, right? You have to have some trade-off between those 2 attributes. They're both desirable attributes, but you need to trade it off to some extent. And so this is again very simplistic, but I put this up on a screen in a speech about 5 years ago, and it was like, oh, we had never thought about this. But the idea that if you got two beneficial attributes to a product, right? You want more of each. So therefore, if you have high knowledge and high independence, you've got better audit quality, right? So you want to climb that dotted line up to the right-hand corner as much as possible, but you can't do that without some constraints in place. For one thing, at the bottom end here, you don't, where the auditor doesn't know anything and the auditor is not independent. You can't believe what they said, but they don't know what they're talking about anyway. So what good are they? They have no economic value. At the other end, we can debate this, but I would argue that there's a diminishing marginal technical returns at some point. There's no such thing as a perfect audit. All right. Zero risk does not exist in pretty much anything, but certainly not in the audit. And it's built into the audit process and the audit risk model. Okay. But the other 2 corners are actually more interesting in some ways. The case where the auditor is really independent, but doesn't have any expertise. Okay. So you can believe what they said if they knew what they were talking about. And then the other case is conflicted expertise, where they really know what they're doing, but can you really believe them? I call that corner, that conflicted expertise. This is me auditing my wife's checkbook, right? I'm not about to give a bad opinion on whatever I find. So in the middle there, we've got a bunch of potential feasible contracts for auditing. Okay, so you got to pick an audit. You're going to, we can just use a classic isoquant and difference curve model, whatever. Again, this is not high-powered stuff, and this is not meant to indicate what it really would look like. This is meant to just be rhetorical. But we don't want audits being anywhere, right? We don't want any audit being sold by any supplier to anybody, because there are externalities to bad auditing, as we know whenever we get an Enron type case, right? There's big externalities, and so we want auditors to be somewhat constrained. So one constraint we use are independence rules. Again, that's not meant to be where I think that line should be. It's just rhetorical. And we're going to say you need a minimum level of independence. And we got, and in the profession, there's a 2-inch thick book, if you printed it these days, that is basically the independence rules for auditors. And they're fascinating. Some are very obvious, like the auditor can't be a shareholder. The auditor can't lend money to the company. The auditor's spouse can't be the CEO. These are very obvious. But then you get into some really weird ones, like, how far into the family do these rules extend, right? Spouses, parents, children, first cousin 3 times removed. There's actually diagrams about the relative, the family trees of how far you have to extend these rules, right? And it's like, I always use the example of, if I was an audit partner, I'd have to, arguably, I might have to ask my brother-in-law what he's invested in. And my brother-in-law doesn't even like me, or hit me for that matter, right? And so you end up with, and then there's actually one rule that says certain people have to be independent as long as if they're within, I think, 200 miles of the office. And I'm thinking, and if you're more than 200 miles, you don't have to be independent. I'm thinking, what's the point? I mean, are we in the world of Pony Express still? Right? With technology, why does distance matter? Okay, so anyway, and then to make sure that we have a minimum level of knowledge, we have just general use of the term auditing standards. They come in different forms on. But basically what's happening here is these constraints are pushing us up the quality curve, right? They're pushing us up to better and better audits. Now, pre-Sarbanes-Oxley, these rules were set by the profession. And we could argue maybe they were too lax. Post-Sarbanes-Oxley, these things are getting pushed up and up and up. In fact, one can argue there's a positive feedback loop in the regulatory structure right now. Whether it's positive or not is not the point. It's just it's self-fulfilling. We find a deficiency in an audit, therefore we need a rule to fix that. But at the same time, that rule, which is fixing that particular deficiency, creates a dead weight loss across the entire market, where most audits don't need that rule necessarily. And so you end up pushing your regulations and your quality. And we want better quality, no doubt about it. But this is being driven by regulation, not by markets, right? That's the point. And then when you bring in inspection, it gets even more complicated. So
question, can we assume that we always want better quality? Because I mean, at some point, there's cost benefits. So for example, the optimal number of murders and robberies is probably not zero, because reducing them to zero would require, extraordinarily sort of totalitarian measures and costly measures. And the same goes for audit. So the optimal number of audit failures isn't zero, right?
Right. Judson, you get an A for the class, because that's exactly the point I'm trying to make, right? So that is the point. And it really gets to what's the Pareto efficient level of regulation, which is going to lead to my next point and final point, really. But you're absolutely right. I think, when, regulators have their incentive structure, and I'm not going to say they're all bad. That's not the point. The point is that when you increase regulation, you increase that regulation on everybody, right? And not everybody needs that regulation, because I'm going to assume like none of us are going to do what you just described. And so we don't need any more laws that prevent us from committing a homicide. But we do know, I mean, we just saw a terrible case in Atlanta, that people will do that. Now, how do you stop that, right? And then we get into real political debates. I'm not going to go there. But that is the nature of the debate. And that's why most regulatory regulations in the United States now are required to go through a cost-benefit analysis. Now, one can ask whether those are very good analyses or not, but at least the requirement exists. Any other questions?
Oh, yeah, Robert. The question is about, it looks like the way you presented, assumes that like independence and expertise, they're like two independent attributes. But, I know there are certain...
I use the word orthogonal. I mean, I use the word orthogonal because the independence word is already being used.
Mm-hmm. That's right. But, in some sense, independence, in a way, it kind of depends on like incentives or what kind of payoff functions the auditor may get. And that could somewhat be related with, let's say, opportunity cost, which would actually depend on expertise.
Right. And I don't disagree with that. The point I'm making is that, and this goes back to the prior section, which is by interactions, you're influenced. And so the idea of being perfectly independent doesn't exist. It's not a feed. So the question is, what degree of independence matters, and how does the independence potentially trade off against your expertise? Because the other factor that I should have mentioned this actually sooner, that expertise is not just audit expertise. It's client expertise. And how do you get client expertise? You have to interact with the client, because this gets back to the idiosyncratic nature of the client. For example, I have a paper that just came out with data from Australia where we show that, in fact, we looked at audit teams, which is not a lot of people have had audit team data. And we found that we looked at the industry expertise of the audit team, which would be arguably somewhat independent of the client. And then we compared that to the client expertise, like how long have they been working on this client? How much team experience do they have with this client? And we found that the bigger driver of audit quality using the measures we have, the bigger driver of audit quality was actually client expertise. Knowing the client better led to better audits. Okay, because you still have to take that industry knowledge and translate it into the client-specific scenario. And this is why these things all kind of hold together. If you're getting the point, there is a point there. They all kind of hold together in that if you start looking at auditing this way, you get a different perspective on how these things will actually work. And independence it's a bedrock of auditing. I mean, this is not the point I'm making. If we're not independent, if we're not credible, we have nothing to sell, because that's all we sell is credibility. But we have to understand how it really works in the real world and what can influence it. And incentives are definitely part of it. But I think the incentives, when we limit it to, when you get into modeling, then you have to have it has to be, constrained to something you can actually analyze. And so it doesn't become an n-dimensional vector of things, of incentives you're dealing with. It's, usually just an incentive. And different incentives will mean different things in different situations at this point. Does that help?
Yeah, definitely helps. Yeah, thanks.
Okay.
Yeah.
Hey, Robert, I have a question. This is
Minwei. Hello, Minwei.
Hi.
There's a lot of people here I haven't seen in ages. Go ahead.
It's good to see you. Yes. So I totally agree. The independence and like the detection, they are correlated. I guess another question I wanted to get your view about is, what if the auditor thought that accounting policy is a breach, but other auditors, it's like Maggie and Chen, other auditors think it's not a breach, and then I change my mind, and I change to agree with the client. Does that mean I compromise my independence, or I just?
Yeah, that question is not embedded in this discussion, but I think that's a great question. I'd have to think how that would flow through. I mean, because the implicit threat is that the auditor is going to get fired, and that the transaction costs are not going to stop the client from doing that. That I would argue that probably is a breach. But the other, this goes back to the earlier comment I think Jim made about how much of the balance sheet is essentially guesstimates, right? Even in a world without all the intangibles he mentioned, in a world of valuations, when we're sitting there in the middle of the audit, or maybe even at the very end of the audit, and you got a bank loss reserve you've got to agree on, right? You got two numbers, at least. You got management's number, you've got the auditor's number, and the only thing you know for sure is they're both wrong, because the future is going to tell you what is potentially right. And two point estimates and a continuous distribution of future outcomes has zero probability of occurring, right? So that means they're not going to, neither of them can possibly be true. But that doesn't mean we can get away with doing nothing. We've got to come to a conclusion. And if we end up with a negotiation process, and it turns out auditor-client negotiations is one of the areas in auditing we've studied where some of this literature actually has been indirectly applied. And it really gets to, for example, we know that we get better negotiated audit outcomes when the auditor has more knowledge intensity, meaning they just know more, right? Knowledge is power in a sense. And so if you don't know much about the client, there's nothing, or the industry, you should know more. You can get bamboozled by the argument that, hey, these guys over there would say this is all right. Why don't you say it's all right? Whereas if I'm literally the smartest guy in the room on accounting standards, I have, I'm not going to say I'm going to stand up every time, but I have a more chance of standing up is the point. And so I think this is something, again, there's another dimension that has not been adequately looked at, but it's interesting. The client negotiation actually is an area where some of this has come kind of snuck in without people realizing they were sneaking into the literature. So it's a good point. I hadn't really thought about the exact, we see that in modeling and some other papers, but I haven't actually thought about how that fits into this framework that I'm kind of building very slowly over many years. I'll make a note to think about that one.
Thank you.
Any other questions? Okay, So last comment. What are we doing with time? Oh, we got the time. Okay. Audit regulation reduces risk for financial statement users. Probably by now you figured out I'm not going to agree with that statement. So I would argue that audit regulation may reduce risk for financial statement users while also producing unintended consequences. And this is an area that I've been actually working in a lot lately. And I like to use a couple illustrations. I mean, let's ask a simple question. I mean, I assume we all have cars. I mean, if you're old as me, you've had cars for a long, long time, right? And so the car I drive today is significantly safer than the car I drove 5 years ago, which was itself was a 10-year-old Honda. And the 10-year-old Honda was significantly safer than the Honda I drove way before that, right? Cars have gotten safer. There's no doubt about it. We all got backup mirrors and lane change signals and all kinds of stuff, right? And now, it drives me crazy, but the thing that keeps you in the lane, I always turn it off because it beeps all the time. Anyway, that's the car traffic safety data for 10 years, not the most recent 10 years, but I found that quickly. So and there's no real, there's a bit of a drop, but it goes back. There's, if you ran a regression line through each of those colors, it's going to be pretty flat, right? That in fact, even though cars are a lot safer, the reality is we don't get better results. We don't get better outcomes. There's still lots and lots of that. Now this is not population adjusted, so you could look at it differently if you adjust it for population. But there's a point there that maybe the regulations and all the safety changes haven't worked the way we thought they would work. Give you another example, though. This is one I really like. Athletics. If I were to ask you which sport is the safest, and we got 4 of them. Okay, well, I have to clarify this when I'm talking to an international audience. Football means American football, which other countries often call gridiron. Baseball is baseball. Soccer, most countries call football, right? And rugby is rugby, okay? Although, if you're in New Zealand, they call it football. So it's like, okay, football gets very confusing after a while. So which is the most dangerous sport to play? Which is the safest sport? Mothers would like to know this. It's like my mother, my son's mother, my wife, had our son play soccer because she thought it was the safest, right? Now, is it the safest? So everybody form an opinion. So you have a prior, and then I'll reveal the data. And what we get is soccer is actually the most dangerous per 1,000. This is based on NCAA statistics, university statistics. These are official university statistics. Soccer is the most dangerous. And rugby, and if you've ever seen a rugby game, these guys are, they wear no pads and they crash into each other like crazy. They look like American football players running around naked, crashing into each other. And they have the lowest rated injuries, right? That people generally get surprised by that result. Baseball is fairly low. That doesn't surprise people. But soccer is, now this is not adjusted by seriousness of injury. This is just a frequency count. So again, there may be another dimension you could look at, but it does give you an idea that maybe our first instincts as to assessing risk aren't always true. We know that from a lot of psychological studies, right? That, for example, we know people are really, really bad at assessing the risk of rare occurrences, which one can argue may be kicking in with society these days when it comes to COVID. But we're really bad at it. Typical risks like driving a car, we tend to underestimate. So, by the way, New Zealand All Blacks, I'd throw that in since I spent part of my chunk of my life in New Zealand. Actually, that's New Zealand behind me. That's Auckland in the background. I'm not there, not yet. Okay, so let's turn this back to auditing then. Well, the PCOB is inspecting auditors since 2004. When they do an inspection, they look at specific audits and they identify deficiencies, or basically things that are wrong or were done wrong or incomplete within an audit. Okay, so deficiency is a mistake, essentially. If you look at what would you expect? Well, they've been doing this since 2004. You would think auditors would get better, right? You would think auditors would be getting better. And so early days, nobody really knew how to do it. So you maybe think things got, there are more deficiencies as everybody learned how to do this. Then you might expect a plateau. And then maybe as auditors got better, a slight drop off. Now, you wouldn't see a big drop off because inspections are risks, they're risk sample. So they're going to look at the potentially worst audits they can find. So you maybe don't expect, but you expect some learning to occur, right? Well, not really, it turns out. That in fact, PCAOB inspections, if you drive a regression line through that for an average effect, it's going to be going up. It's got a positive slope, right? And since those of us who do empirical work, we talk about the difference between causation and correlation, but we really know, I know in my heart that correlation means causation, right? No, obviously I don't, but it's like, if you did, you'd say, oh, the longer the PCAOB is around, the worse the audits get, which of course makes no sense. Study I did in Australia, looking at this as applied to a specific regulation in Australia. This was an amazing opportunity for me. We got access to the top audit partners for all the major firms. We got access to the regulators. We got access to the standard setters. We got access to the top audit committees to basically do a study looking at what they thought the relationship between regulation and audit quality was. The blue line was the regulators and standard setters, right? More was always better, this positive feedback loop. At work here, that they said basically the more regulation and more standards we set, the better auditors are going to do their job. But the partners that we talked to, maybe that's not a surprise, but what was really interesting is the audit committee people we talked to felt very differently. They felt at some level of regulation, they were actually worried they were already past the tipping point where compliance became more important than actual quality of the audit. Now you would hope that there'd be a high correlation between process compliance and outcome quality. But clearly there was this concern that there was a tipping point either coming or already past, that while, particularly if you go back to some of the other things I'm talking about, where basically you're working within a budget arena, you only have so much time to devote to so many things. If you spend it doing compliance work, you don't have time to do maybe things what should be doing that's more directly relevant to the outcome of the audit itself. That's still a speculative conclusion. I mean, it's based on personal opinion, so that could be biased, although I think the audit committee members was the telling signal there. But it is a question that's getting more and more attention. And it gets back to Judson's comment, I think, about, is there a point where more regulation is too much regulation? So just to conclude, I'm going to wrap this up in a second. I got curious. Why do you get all these unintended consequences? Well, this is the purest form of research. It's called Google. So I just Googled this one day, and like literally 5 minutes, I found 4 theories that explain why you get unintended consequences from this kind of stuff. 2 are economic based and 2 are cognitive based. Theory of moral hazard, we all know that, right? That's economic based. People take on more risk if they perceive that others bear the cost of that risk. And think about how that might apply. The more you improve corporate governance, the more you improve the audit, do you actually create a mindset where investors, at least some groups of investors, don't worry about risk anymore? They just take it for granted. They stop being willing to protect themselves. I don't know. I mean, it's a question, right? Theory of self-licensing, also called theory of moral license. This is more related to cognitive issues. And this is basically that people will convince themselves that something they did was good will excuse something they do that's bad. Right? And so they'll take on more risk if they perceive that virtuous actions balance against the bad actions. And the classic story you hear there is work out in the gym for an hour and then have ice cream on the way home. Right? Now, that doesn't mean you're not better off, right? I mean, it just means that there is a thought process that works through, that people go through, that allows them to rationalize things. A third theory, and this actually comes from economics. This is something I've actually been wanting to get into, and I haven't been able to figure out a way to do it yet. But theory of risk compensation, the idea that people alter their behavior in response to a perceived level of risk. This is actually the theory that underlies some of the athletic data. If you think about football, American football, those athletes are really basically plastic encased missiles, right? They can plow into anybody and they're not even going to feel it. Now, the guy that gets hits may feel it, but the guy doing the hitting isn't necessarily going to feel it much. And so they feel safe, so they can hit harder. Right? They can be more aggressive. This is also a big area that's been studied in cars, right? The idea that, again, the safer the car feels, the more aggressive a driver may be. And I really like this last point. Tulloch's spike This is an experiment that was done that people will drive more carefully and a sharp spike is mounted on the steering wheel. By the way, that was not a real experiment. It was a thought experiment. I don't think this could get through any IRB at any university I know, where you could approve having people drive around with sharp spikes on their steering wheel just to see if they drive safer. And then finally, theory of resistance behavior. And this is another cognitive theory that increased interventions cause the target to resist the limitations. And the easiest way to understand that for somebody like me is anybody who's ever raised a teenager knows exactly how this works, right? The more you tell them what to do, the less they're going to do it, it seems like. I think we may be in a period again with COVID where this is kicking in. People are tired of being locked down. And so you see people resist. So the point is, there's actually a lot of reasons why regulation doesn't always work the way it's intended. And so I think, more work looking at that could be useful. And then I got a whole bunch of I'll just throw this up for the moment. There's a whole bunch of economic issues I think that we could be looking at different directions with more to gain. So at this point, it's according to my clock, I still got 15 minutes, 14 minutes. Any questions, comments?
I had a couple of questions. So one is, what impact has the new regulatory regime had on private liability? So for example, the audit firm's ability to mount a defense and to demonstrate, that there was not an audit failure in terms of their actions. So, is there a clear sort of roadmap for them to defend? And then the other question that I had is, what's not come up is there's some ways in which audits behave as like an insurance policy on the financial statements, where if there is a misstatement, you have somebody to sue. And how much is that? How much of a role does that play in audit quality?
I'm not an expert on that literature. There is some evidence that after I think it was the 1996 Reform Act, that it definitely became harder to sue an audit firm. I think there's a lot of noisiness. It's inefficient and uncertain to rely on litigation, even in the United States, to enforce audit quality. I don't think it's as effective as a barrier as people think it is, because for one reason, you're talking about individual decisions. A partner, I saw Pierre a minute, he's not on my screen right now. Pierre has a great paper with Steve Huddard on partnerships and basically shared liability. And I rely upon that with some of my research on partner compensation. And the idea that in a partnership, how you self-monitor has a big effect on this, because on how good the job is done, the quality is, because when you may reap the benefits of making bad decisions when they work out, but you share the losses when they don't work out. And so it's not clear to me that litigation exposure is an effective brake on bad audit quality. Certainly, Simonic model includes that in the audit fee model, but I think it's probably more effective to think about other forms of enforcement. For example, currently in our current world, the PCOB inspection is a more effective form of enforcement. For example, I have a friend who's an audit partner for a Big Four firm in Florida, and he just went through a PCOB inspection, well, it was about a year ago now, and they found one deficiency as an audit, one problem, one thing that they felt his team had not done well or not properly. And the firm fined him $10,000. They basically took it straight out of his paycheck. That's a penalty, and that's immediate, versus a litigation, and who knows how long that could take. So, there may be other enforcement. And I have a paper that's coming out in the accounting review where we're using data. Now, this is a low litigation environment. We're using data from Belgium. Low litigation environment, right? And so you wonder, how do you enforce audit quality where there's no litigation? Well, we got data. It's been interesting. That first paper on audit partner compensation that came out of Sweden that was published in JAR just opened a whole floodgate of stuff like that could get to do, which is really fascinating. But anyway, in Belgium, it turns out, and maybe somebody's interested in pursuing this, I can refer you to the people who have the data. In Belgium, every audit partner has to file a personal financial statement with the government. Personal. It's balance sheet and income statement mainly. There may be a little more to it, but there's certainly a balance sheet and income statement. And so we could look up every audit partner in every big 8 firm. I say 8 because there are eight big firms in Europe. It obviously includes the big 4. And we could look them all up, and we could see for a number of years what their personal financial status was. Now, if you remember, I referred to Ron Dye's paper back in the Journal of Political Economics back in the 90s, and he talked about wealth serves as a bond for audit quality, because wealth is something you have at risk, and the litigation, this is the issue. We actually found that, well, in a low litigation environment, wealth is not the issue. Debt is the issue. Because in a multi-period world, you've undertaken a lot of debt, some of which is going to be related to, for example, your house because of a mortgage. You actually are more cautious because you cannot afford to lose your future cash flow. It's not so much your past, what you've done before, or whatever your wealth is today. It's losing the future cash flow, because your second best use, if you're not going to be an audit partner because you lost your job, it's probably not going to pay nearly as well. And so we found that the level of debt was actually the driver of audit quality. Now, does that translate to the United States? I have no idea, but it's something we could test in Belgium. We can't test here. Maybe someday we'll figure out how to test some of these things some other way. But yeah, so litigation, that's an interesting, it's very convenient for modeling, but I think if you interpret it more broadly than literally just litigation, I think it's fine. There's nothing wrong with that, because we're really talking about what is the downside of screwing up. And it's just saying it's litigation it's not clear to me if that's either efficient or certain enough to do the job.
Robert, can I ask you a question?
I think I just irritated everybody now. Sorry. Yeah, Phil.
Hey, thanks for your talk today. It's been really interesting. I'd like to follow up on the second point that you made regarding this production process, and you extended that to speak to the service process. But I was particularly interested in your views on it being a singular client entity that is focused on, and particularly when you tie your fourth point with regard to regulation in an ecosystem. How do you think of audit quality in the context of an ecosystem where auditors are learning across engagements? And then when we look at regulation, where the PCAOB tends to evaluate, as best as I can understand, one firm at a time.
Yeah. You're absolutely, that's a great question. And I actually cut out a couple slides that were on point on quality in assurance in an ecosystem, because I thought I wouldn't have time. But yeah, the basic point is, then you've got if you really do have all these kind of moving parts, shall we call them, then each one of those moving parts has a role to play, and audit quality then depends upon how well each part does their job. And so, there's evidence that suggests how specific parts can break down and undermine audit quality. For example, there's a literature that suggests it's not a good idea to have the CEO also be the chairman of the board, right? And so, because that suggests that one's a management role, one's a governance role, and possibly because of the combination, now the governance role gets dominated by management. So that's not good. And so domination within the model, the system, is not a good thing. Deference is another problem you run into, where, okay, maybe I'm a honorary member of the board. I'm not going to really argue with anybody. I like coming to these meetings all the time and getting fancy dinners when we could do it, right? And so I don't argue with anybody. So deference is a danger. And so there's a lot of different issues. You're absolutely right. There's a lot of different types of signals of potential quality problems, rather than just, did the auditor do the audit right or not? And so then what I argue is, you can't solve all those problems by only looking at the auditor. Right? The auditor cannot compensate for every one of those problems, because basically you're living in a world of huge network of information asymmetry. It's a cooperative network, but it's also a network of information asymmetry. And so, how do you manage that? And Jeroen can tell the story about how we tried to model some of this once upon a time, and where we got with that, which was kind of not far, but because it gets obviously extremely complicated. But that's a great question. And if you want to follow up with me, send me a note and I can send you some stuff on that point.
Very much.
Anybody else have a question? I mean, I can actually talk about some of these issues, but I think most of them are, I kind of threw clues in there a little bit. The interesting one that I've worked around with is this debate about whether audit markets should be modeled as a Bertrand or a Cournot oligopoly, because they, obviously in the UK for sure, there's this argument that the big four are too concentrated. We need to break them up. And there's a lot of arguments that goes the other way too, that suggests that's going to reduce audit quality. I mean, part of the problem is when you're auditing global multinationals, you need to have a global multinational firm to do it. And in reality, audit firms are not multinational, not in the sense we usually mean the term. KPMG is not KPMG, is not one KPMG firm. It's 150 KPMG firms, because every country has their own firm, and they're only bound together by contract and co-branding. That's it. And so that creates all kinds of challenges themselves. They rise above the existing regulatory structure, which is national at the national level. And while there is a global regulatory organization called IFIR, it doesn't have any teeth at this point. And so we can only regulate auditing at the national level. And so in a sense, the audit firms operate in this area outside of the control of any single country. The last point I actually want to also talk about, because this is one that we just take for granted, and it's something I've been thinking about. Audit firms can be efficiently organized as partnerships. Part of this issue is, in fact, this has come up in Europe recently. Should we allow firms to undertake some kind of organizational structure other than a partnership? And the logic is, and this gets back to some things Jim said, given the investment that's necessary to move auditing into the 21st century, is you need a lot of free cash flow from your underlying service. And if the audit is essentially done as a commodity at a commodity price, there's not a lot of free cash flow when you get done. And so it becomes a real issue of how do you generate enough capital to invest in the systems, the IT systems you need to really move into a world where auditing will become much more dependent upon, for example, artificial intelligence. And so that's another issue that's getting discussed. So there are a lot of good economic issues out there. I'm not convinced, like I said, that most of the perspectives we see are necessarily reasonable or realistic, but it's certainly worth discussing. So I'm going to close with my favorite quote. Every problem has a solution, which is simple, clean, and wrong. And that kind of follows from my discussion of regulation. H.L. Mencken was a journalist in the United States, and I just love this quote.